$377 million in emergency room bills in a single year, more than NASA spent launching Apollo 11, and every dollar of it was charged to people playing a backyard game with a plastic ball. The sport that caused those injuries is the same one that 24 million Americans now call their favorite weekend activity. It's also the same one whose largest franchise network has lost nearly $14 million in aggregate. Pickleball didn't collapse because people stopped loving it. Pickleball is collapsing because the exact demographic that made it explode, 77 million baby boomers aging out of tennis, is now aging out of pickleball, and nobody behind them is showing up to fill the courts. If you hold shares in any leisure sector ETF, any consumer discretionary fund, or any REIT with fitness and recreation tenants in its portfolio, this story isn't about somebody else's money. It's about a line item on your next quarterly statement. I sat on this story for 2 weeks before deciding it was worth your time. Here's why it is. The financial disclosures that prove what's happening just became public, and almost nobody has read them. You remember the moment. Maybe it was 2019, maybe it was 2021. Your doctor looked at an MRI of your Achilles or your elbow and said something you didn't want to hear, that the tennis you'd played since college was done. And then somebody handed you a shorter paddle on a smaller court, and for the first time in a year, you felt like an athlete again. That moment happened to millions of Americans at roughly the same time. It built a $4 billion industry in under 5 years. And that industry is now discovering that the demographic clock that launched it is the same clock that's winding it down. Here's what this story is actually about. Who got rich writing franchise agreements while ordinary investors, people with a spare million in retirement savings looking for a small business, signed leases they will never earn back? And here's what nobody is asking yet. The private equity firm that just wrote the biggest check in pickleball history, Apollo Global Management, $225 million, is using a playbook you've seen destroy value in retail, in fitness, and in media. The company doing it today, right now, with your potential exposure, doesn't get named until the end of this story. How does a sport go from the fastest growing activity in America to a financial trap for everyone except the people selling shovels? And if the people managing your retirement capital are making bets like this one, structured exactly like bets that have failed before in industries you remember, what would it take for you to know before it was too late? If that question just landed somewhere specific in your gut, subscribe. One documented story like this every week, built for people who actually read the filings. The reason Apollo's $225 million check looks like confidence but smells like something else was decided not in a boardroom in 2025, but on a backyard court on Bainbridge Island, Washington in 1965 by a group of fathers trying to keep their kids from being bored. The Shovel Sellers. Joel Pritchard, a Washington state congressman, and his friends Bill Bell and Barney McCallum lowered a badminton net on a backyard court in the summer of 1965 and handed their children ping pong paddles and a perforated plastic ball. The sport they invented that afternoon wouldn't register a single dollar of commercial revenue for nearly 4 decades. What grew it wasn't marketing. It was orthopedic necessity. By 2015, the youngest baby boomers were turning 50. Tennis participation among Americans over 60 dropped steadily throughout the 2000s. Pickleball, lower impact, smaller court, shorter rallies, absorbed those players the way a sponge absorbs water nobody bothered to wipe up. You don't know this yet, but the franchise document that reveals exactly how badly the economics work for the people who invested the most That document became public in early 2026. The executive who signed the franchise disclosure is now watching his own network's numbers prove the model doesn't function. He hasn't addressed it publicly. The COVID pandemic in 2020 compressed a decade of growth into 3 years. From 4.8 million active players in 2021 to nearly 25 million by 2024. Courts multiplied, 84,000 across the country by some counts. And where courts multiplied, entrepreneurs followed, checkbooks open. The franchise model seemed obvious. It had worked for Planet Fitness. It had worked for Orange Theory. The theory was simple: sell memberships, oversell capacity, collect monthly fees from people who sign up in January and never return after February. But pickleball players aren't gym members. They show up. They play 2, 3, 4 days a week. They bring friends. They stay for hours. Every court hour a member uses is a court hour nobody else can buy. The entire gym membership model, the model every franchise pitch deck borrowed, depends on customers not using what they paid for. Pickleball's customers use every minute. Somewhere in suburban America, maybe outside Dallas, maybe near Tampa, a franchisee who believed that pitch deck signed a lease at $15 to $20 per square foot and invested up to $2.1 million to open a pickleball club under the Picklr brand, the largest franchisor in the space with 68 locations sold. That franchisee didn't know, couldn't have known, that the typical profit on a location grossing $940,000 in revenue was roughly $90,000, a return under 5%. A 6-month treasury bill with zero risk and zero employees paid better. Meanwhile, the wealthiest boomers, the ones the franchise model needed most, were building private courts behind their own houses. There's one within 200 feet of where I'm standing. And players like the ones I play with in San Antonio found public courts for $5 a session. 3 hours. The Picklr's franchise network, by the time it was required to publish financial disclosures in 2026, had accumulated nearly $14 million in aggregate losses across its system. And Pickleball Club, one of the 5 largest franchisors, quietly stopped accepting new franchisees altogether. The machine that was supposed to print money for small investors was consuming their capital at a rate no disclosure document warned them about. And Apollo Global Management was about to write a check that would make the whole thing look like it was just getting started. The Wiffle-Ball arms race. Over 1,000 brands now manufacture pickleball paddles. Set that number next to this one. Roughly 20 factories in China produce nearly all of them. The difference between a $279 JOOLA Gen 3 and a $60 paddle from a brand you've never heard of is, in most cases, a logo and a marketing budget. Competitive players know this. They swap paddles every 3 to 6 months. Brand loyalty in pickleball equipment is nearly non-existent because the product underneath the decal is nearly identical. JOOLA, Sport Squad Inc., agreed in August 2025 to pay $790,000 to settle a class action lawsuit alleging its Gen 3 paddles were falsely advertised. Preliminary approval came from U.S. Magistrate Judge Panayota Augustin Birch. Class members with proof of purchase receive $300 back on a paddle that retailed for $235 to $279. Then, on April 7, 2026, JOOLA filed patent infringement complaints against 11 competing brands: Franklin, Proton, Engage, Adidas, and 7 others, across 6 federal jurisdictions simultaneously, plus a complaint with the U.S. International Trade Commission. Padel Tech and Pro XR settled first, agreeing to pay royalties and discontinue specific paddle lines. I'll be honest, I didn't expect the injury number to be this specific. 67,000 emergency room visits in 2023. Average patient age, 64. Total medical cost, $377 million. 6 times what the entire professional pickleball tour generates in annual revenue. The most common career-ending injury? A ruptured Achilles tendon. And here's what the aggregate statistics miss entirely. Pickleball is a social sport. It's played in groups of 4 to 8 regulars who show up together 3 mornings a week at the same courts. When one player, especially the one who organized the group, tears an Achilles, the whole group stops playing. 6 or 8 people sidelined by one injury. That compounding effect doesn't appear in any franchise pitch deck. Set the numbers aside for a moment. There's a man, maybe 66, maybe 70, standing at his mailbox on a Tuesday in early 2026. He opened a pickleball franchise 18 months earlier with money from a self-directed IRA. The envelope contains the quarterly statement. Revenue is real, the courts are busy, but the margin, after rent, insurance, equipment replacement, and the franchise fee, leaves less than his previous Social Security estimate assumed he'd need. He doesn't open the second envelope, the one from the franchisor, for 4 days. Apollo Global Management and its partner Dundon Capital said their $225 million investment in Pickleball Inc., the parent company of Major League Pickleball and the PPA Tour, represented a major vote of confidence in the sport's growth trajectory. The record shows something different. By the time that deal closed, new court construction in the top 100 U.S. cities had decelerated from 14% year-over-year growth to just 4%. Gamma Sports, one of the largest equipment manufacturers, had declared bankruptcy citing slowing demand. The Picklr's franchise system had posted its aggregate $14 million loss. The confidence Apollo expressed and the conditions Apollo bought into existed in the same quarter, on the same page of the same industry report. If the people allocating capital in your retirement fund rely on headline announcements rather than franchise disclosure documents, and most of them do, then subscribe. This is the kind of story that doesn't make the evening news until the losses are already permanent. That $225 million check from Apollo didn't come from Apollo's flagship fund. It came from something called Apollo Sports Capital, a brand new vehicle launched in September 2025, 9 months before the pickleball deal closed. The demographic clock. Apollo Sports Capital deployed $225 million into Pickleball Inc. at a reported valuation of $750 million, for a combined entity generating $60 million in 2025 revenue and projecting $74 million in 2026. That's a revenue multiple north of 10 in an industry whose participant growth rate had already flattened. The cynical read, and the documented one, is that a new fund needs a marquee deployment to attract the next round of limited partners and begin collecting management fees. The pickleball bet may be less about pickleball and more about Apollo Sports Capital's own fundraising cycle. This is not a new story. Private equity entered fitness before. Bain Capital's Varsity Brands was sold to KKR for $4.75 billion in 2024, after Bain had already settled 2 antitrust class action lawsuits for a combined $126 million. The mechanism is the same. Acquire the league or the governing body, consolidate revenue streams, extract fees, exit before the demographic math catches up. The franchise holders and the local operators absorb the downside. The fund collects its carry on the upside. The signal was there. It had been there for some time. The youngest baby boomers are 62. The oldest are 80. The generation that drove pickleball's explosion is aging out of pickleball the same way it aged out of tennis. Not by choice, but by biology. Behind them, Generation X, born between 1965 and 1980, numbers only 65 million, 10 to 15% smaller. And Gen X is still working, still paying mortgages, still funding college tuition. The discretionary Wednesday morning court time that retired boomers filled doesn't exist in a Gen X schedule. Behind Gen X, Millennials and Gen Z present a different problem entirely. They don't want the structured, rules-heavy, $130 a month club membership that the franchise model requires. They want casual drop-in play, beach volleyball rules, not country club rules. And they've found Padel, a glass-walled, high-energy racket sport that originated in Europe, films well on social media, and is growing in exactly the urban markets pickleball needs. Padel is picking off precisely the younger demographic that pickleball cannot afford to lose. The board at Pickleball Inc. had the court growth deceleration data from 14% down to 4% for 6 weeks before announcing the Apollo deal. No one on the call asked to reconcile the growth narrative with the construction numbers. Lifetime Fitness, publicly traded, ticker LTH, now operates over 800 permanent pickleball courts across 190 clubs. Lifetime funds its expansion partly through sale-leaseback transactions, the same structure the pickleball club uses. Build the facility, sell the real estate to a REIT, lease it back at 6.9% of development cost. In Sarasota, that means $34,500 a month in rent on a $6 million facility. Rent that doesn't flex when membership does. The Pickleball Club's own Republic.com filing forecasts a 6.5% compound return on realty value over 5 years. That's the number before a single Achilles tendon ruptures, before a single competitor opens across the street, before a single boomer decides 81 is too old. And there's a force nobody in pickleball is talking about. America's reindustrialization push, driven by federal manufacturing incentives and reshoring subsidies, is creating intense demand for the same light industrial warehouse space that pickleball facilities occupy. Buildings leased at $15 to $20 per square foot for pickleball courts are exactly the buildings that electrical transformer manufacturers and battery assemblers will pay $25 to $30 for. The landlord's phone is ringing. The pickleball tenant's lease has an expiration date. Jim Dundon signed the investment memo. The franchisee in Tampa signed the lease. One of them will be fine. The $225 million deployment wasn't a bet on pickleball's future. It was a bet that the fund could exit before the demographic math arrived. And the franchisees, the ones who put up the real estate deposits and the self-directed IRA transfers, are the ones who will still be holding the lease when it does. Verdict. The Apollo Sports Capital check cleared. The franchise disclosure documents became public. The deceleration data was in both documents, on overlapping timelines, visible to anyone who read past the press release. The convergence happened exactly as the numbers predicted. Not because anyone lied, but because the people writing the checks and the people signing the leases were reading different pages of the same story. 1. Joel Pritchard invented a backyard game in 1965 to entertain bored children. And 60 years later, a private equity firm valued the professional league built on that game at $750 million. A figure derived not from the sport's economics, but from a new fund's need to deploy capital at scale before its first fundraising window closed. 2. The franchise model borrowed from Planet Fitness was imported into pickleball without adjusting for the one variable that makes fitness franchises profitable: customer absence. Every pickleball franchisee who signed a lease was betting that members would behave like gym members. They didn't. They showed up. They played. And every hour they played was an hour the facility couldn't resell. 3. The demographic window that created pickleball's boom. Baby boomers between 60 and 75, too old for tennis, young enough for a smaller court, was always finite. It was visible in census data, in orthopedic injury reports, in the 14% to 4% deceleration of new court construction. Nobody who invested in the growth narrative consulted an actuarial table. The exit was there. The sport's own participation data published it. The franchise operators who signed 10-year and 15-year leases didn't model what happens when the median player turns 75 and the next generation is 15% smaller and already playing Padel. I've stopped assuming that the people writing the largest checks have read the documents that matter most. This story is why. Every boom and bust cycle in recreation follows the same arc. Baseball cards in the 90s, rollerblading in the 2000s, and now pickleball in the 2020s. The difference this time is the dollar amounts. A kid losing money on a shoebox of Ken Griffey Jr. rookies is not the same as a 63-year-old losing $1.2 million from a self-directed IRA on a franchise whose own disclosure documents show sub 5% returns. The stakes scaled.